Welcome to the weekly update, where I'll go over the action in the market for the week of September 30th through October 4th, and then we'll see how things look for the week of October 7th through the 11th. We spent most of the week being negative. Well, the employment report came out on Friday. There was positive reaction to that on below average volume, but it was enough to push the indexes a little higher. We did not set a new all-time high with the S&P 500, but we did with the Dow. Small caps for the week ended up being down, but they had a good day on Friday. So before I get started into the video, please know that if you really want to find out what's going on in the market, the daily videos are the place to view that, at least according to my commentary and analysis. I know my videos are longer. They're designed that way. I want to keep away the people that are looking for fast answers in 3 or 4 minutes and just tell you their opinions. I'm trying to teach a skill here to actually develop folks into the ability to know what charts are important and then how to interpret those charts. So that's all by design here. So I get a little feedback from that every once in a while, but I gladly take it because this is how I've designed everything here. But if you really want to know what's going on a day in and day out basis, because sometimes these changes are slow, they're incremental, the daily video is the place to do that. I also make a PDF available in the description below this video and every video that I post. Every day I update pivot points on the YouTube community tab. There are those that last for the whole month, and there's another chart that gives you the pivot points just for that particular day. I do have a private Facebook group. Now, there's a program I'll tell you about here in just a moment. Not everybody will be interested in that. If you want to have some more communication with me and you belong to Facebook, feel free to click on the link in the description. That will take you to the Facebook group. I'll let you in there. You can ask me questions. We can go back and forth with things. It's not an active Facebook group, and it's not an awful lot of members. But if you want to change that, you're more than welcome to do it. I do really watch YouTube and Rumble comments. I just worry about the legitimate comments. I get a lot of spam on there too, and I delete that. In fact, I'm coming up with what I think is kind of a clever idea on how to deal with that. But if you have a comment and you don't mind other people also seeing that comment, you are more than welcome to leave it. I also provide an email address with every video that I upload and post. You can send me that if you want to keep things more private. I do also post on Rumble as well as YouTube. I use that kind of as a backup. Sometimes I'll have trouble uploading to YouTube or Rumble. Go to the other platform and see if the video is there, if it's during a time when you expect it to be there. There's a thing called the SPXInvesting Program. I developed it myself. It's up, it's going, it's currently free. It'll be free until the end of 2024. Then I have a whole membership program, and I do additional videos on there. We have some back and forth. You have the ability to set up a time with me on Zoom or Skype if you want to talk about things. There are courses that I've developed myself that you might find helpful. And I have my own unique approach to this whole thing that has stood the decades of time, a lot of years of experience, a lot of years of consistent success. And I'm trying to teach that in this program. You also get immediate access to the daily and weekly videos as soon as they are uploaded, where I hold those off with YouTube and Rumble. This is where I talk about the daily video. Now, I know people are busy. You can't always watch all these videos. You're not necessarily interested in it. You take a longer term approach. I hit a lot of longer term stuff in the daily video and in the program that I have developed, mainly with how to protect yourself. You know, you don't have to have any losses in the stock market. It's a very easy thing to overcome. You just need to know about it. And that's what I teach in the program. So let's go back and talk about this week's session. We were up 0.22%, so just under 0.25%, but it was still an up week anyway. We were below average with volume, especially in Friday's session. That's where we saw things start to recuperate a little bit and shoot a little bit higher going into the close. The biggest economic report of the month, and we're below average with volume, that's a concern. But we were also below average for the entire week. We are positive for right now, and I'll go through all the different charts. And inflation and interest rates, Inflation's coming down. Interest rates have been going back up, and they went up on Friday, but that didn't seem to have much of an impact on stocks. Stocks wanted to go up anyway. And we're really focused on the geopolitical concerns right now, specifically in the Middle East, and even more specifically in Israel. In fact, when I did the weekly video a week ago, I was in Israel. Right after doing that video, some news broke, and I said, okay, we got to get out of here. And we spent 4 days getting out of Israel, across Europe, and back to where I'm currently residing. It wasn't really that terrible. It's just a lot of time sitting in airports and riding on bouncy buses. But it's probably going to escalate even more from here based on Israel's response back to Iran. Now it's more Iran and Israel. I mean, they pretty much have taken care of Hamas. They're decimating Hezbollah. Those are the satellite groups of Iran. Now it's more Iran and Israel directly with each other, which could bring in Syria, it could bring in Iraq, and things like that. So it does have the potential of really escalating. I hope it doesn't. I hope all of that is just a lot of talk that never happens. But the way these things go and with the years of history behind all of this stuff, it could escalate. So we want to keep an eye on that because that can have an impact on the market. Right now, it is making oil go back up. Now, oil can go up if the companies are making more money and the stock market's going up as well, and oil and stocks can go up together. It's why is oil going up? Well, there's this thing called the Strait of Hormuz, which Iran controls. They shut that down, and it's going to block oil coming out of the Middle East, and that's going to shoot oil up even more. So we want to just pay attention to this because not only does it affect us personally in our lives, but also it can have an impact on the stock market. Now, for the most part, all these geopolitical events, other than lasting 1 or 2 days, they really haven't impacted stocks. We'll see, is that going to change somewhere along the line? Okay, the condition of our trend. We're still in a weakening trending environment, but we are trending. I'll show you the chart of that. We are still positive with our trend right now. So here's some bullet points. Geopolitical events escalated this week in the Middle East, which is causing oil to rise. Hasn't really impacted stocks yet, but if it keeps shooting up, and that's also going to affect people at the gas pumps. This is also during a political time, so you got all the political maneuvering going on. It doesn't necessarily do good for people. It just does good. At least the people running for office think it'll do good. They'll say anything they have to try to get elected. Stocks did end up closing slightly higher, not by much. And the employment situation report was taken as positive. The soft landing scenario, the idea that we're not going to go into a recession, that's still viable for the time being. It could change at some point, but we've been watching this week after week, month after month, and that scenario, other than a little bit of doubts here and there, we've always switched back to this idea that we're not going to go into a recession, but that could still change. And then growth concerns are coming mainly as the week played out because you had this strike, and you probably heard about that in the news. The dock workers went on strike on the East Coast and in the Gulf Coast. Well, that got resolved later in the week. So that appears to be, at least for the time being. Now, it could flare up again at some point, but it does seem to be settled for right now. And then interest rates were up. Now, we're getting back up to that 4% area. And at some point, this is going to matter to stocks if we keep going up. But we were at 3.75% a week ago. We're almost at 4% now. That's 0.25% in 1 week, almost 0.25%. And that could really start to impact stocks if they take note of that. And the dollar was up. Now, it's still in a downtrend, but it really bounced up solid. It went down to that 100 level and is just bouncing up off of that. Both of these together typically put stress on stocks. They haven't seemed to do much yet anyway, but that could change if we still see interest rates going up and the dollar going up. All right. So for the week, the Dow was up 0.1% and actually closed at an all-time high on Friday. The NASDAQ was up 0.1%, and everything would have been negative. It was a little push at the end on Friday that ended up taking things positive. We were up 0.2% with the S&P. Small caps, even though they had a good day on Friday, they were still down 0.5% on the week. This is a chart I've been showing for about a year and a half. This is showing the blue line here with inflation coming down during the period from 1966 to 1982, and we still seem to be in this general phase with inflation coming down. But be aware, it doesn't necessarily mean it's just going to keep going down, down, down. Now, it could, but right after that is when we saw a number of years here of hyperinflation and everything switched. And it looked like everything was looking good back in 1975, 76. And then we had our bicentennial year, and then inflation just took off after that. There was also a change in the administration during that time. And it went from, we had Watergate with Nixon, and then he resigned, and then Ford came in. And then after that, Jimmy Carter was elected. And that's when all of this stuff really started to happen. It really didn't get under control again until Ronald Reagan came in with his economic ideas, which not everybody liked, but at least it brought inflation down. And we're wondering if a similar type of thing is going to happen this time. Okay, now we are still below this 4.02%, which RenMac has determined once we get above that, that's when it really starts to impact corporate profits. We're at 3.98%, so we're still below that level, at least for right now. Now, this was updated with the employment situation report coming out. This chart was updated as well. We want to keep an eye on this. These are long-term unemployed, 27 weeks and over. That means over 6 months. And it is starting to go up. And you can see the number up here on the left-hand side. It is rising. So there is a bit of an increase in the long-term unemployed. Then I did get a chance to update the Isabel Net blog charts. The takeaway from this is you see the red arrow, which I put on here. It's just showing that earnings are going up, looking out into the future, and that justifies stock prices going up. Then we have the S&P 500 level and the earnings per share. This is according to Goldman Sachs, where they think earnings are going to go up, and that justifies the S&P going up. We're right around 5,700 right now. We're a little bit above that. But they think that 12 months out from now, we could actually be at 6,300 for the S&P. Now, when everything's looking rosy and the economy seems to be doing a little bit better, all their forecasts are up. We hit a bit of a downtime, and all these numbers are going to switch to, oh no, the end of the world is near. So you kind of have to take these charts with a grain of salt. They're based around emotion, not necessarily all the time logic. All right, then looking at the U.S. valuations, and I cover this also in the intermarket analysis video, we're at 22% right now with the forward PE ratio. That's expensive. When we get above that 20 level, that's when it's considered quite high. And you can compare that. Here, the whole rest of the world's at 19, and we go all the way down here to emerging markets, which are at 12.3. And some people find this attractive. They do their investing based on these numbers. Now, I don't, because we've been over 20 now for months, and you would have missed out a lot of gains during that time. Just because we're down around 12, that doesn't mean we're cheap either. There might be some problems in these companies. So you have to take it a step further to see, okay, the valuation looks all right. Now let's go look at the fundamentals inside and see if that justifies actually doing an investment. All right, and then China is really having a lot of troubles economically. Their stock market was going down. And then a week ago, they came out with a lot of announcements saying we're going to cut these rates, we're going to make money easier to get, all the things that countries usually do to try to stimulate their economy. Well, because of that, now we're seeing a lot of money just flying into China, thinking that, okay, we can get ahead of the curve here. Finally, things maybe are looking a little bit better. And so we see a lot of money going in. And Bank of America private clients, they're continuing to add to their T-notes. That's treasury notes here. And these are the different maturities. I remember this as BINBO. I know it's a play on bimbo. Bills, that's B, and then in, and then bow. That's how I remember them, because the T-bills, they're the shortest term. Then we have the medium term and then the long term. BINBO. I don't know if that'll help somebody. If it does, you're welcome. All right, and then China stimulus, okay? They're starting to put a lot of money back in here, and that could help things, especially when you look at the forward PE ratio for China right now. A lot of news about China. these days. But other than companies doing business in China, and a lot of those companies are S&P 500 companies, I don't deal with the Chinese government. I teach Chinese children English, and I do that online, but I don't deal with their stock market. There's a lot of things that still need to be fixed in that market, in my opinion. All right, percent of S&P 500 companies, market cap reported earnings. This just shows the earnings that have come out and their market caps and so forth. All right, then, how would you describe the global economy over the next 12 months? About half the people think we're going to go into stagflation, but that's really coming down. That's where we have super high inflation, but really no economic growth. And then it's a little bit more here that stagflation is actually increasing. All right. And then we have Goldilocks. And that's kind of what the market's thinking right now. Everything's just right. Not too hot, not too cold. And 6% think it's going to be a boom going forward. Okay. These are all opinions here. Nobody knows for sure what's really going to happen. This is just what do people think. Okay, gold is the best performing asset in 2024. Oil is the worst. I don't agree with that because when you compare gold to the S&P 500, they're pretty much chopping sideways with how they've been performing. It might be leading a little bit right now, but this is just comparing gold with oil. Oil's been under pressure, but now it's starting to go up because of geopolitical tensions. All right, FactCheck. I put a bunch of charts on here. Basically, they asked the question, did analysts cut earnings per share estimates more than average for the S&P 500 in the third quarter? And here's the takeaway. The answer is yes, they did. And here is how they cut them over a period of time. This is showing a couple of charts how they are lowering the earnings per share. And the kind of deceiving thing is, yeah, they cut them more than average. Okay, that kind of puts another qualifier into this whole mess, but they did cut them a bit here. All right. Now, looking at the intraday chart, here is Monday. We looked a little bit better at the close on Monday, but then we just came right back down on Tuesday. We spent a lot of time just chopping around. You see this chart, there's really no conviction. There's little periods of time here when we shoot higher, shoot lower, but an awful lot of choppiness. We really didn't see any conviction until about the latter part of Friday, and that's what ended up taking things positive overall. So for the week, and I measure this a little bit different. First of all, this only measures the 5 trading days. It's not Friday to Friday, it's Monday through Friday. And we had the NYSE, which ended up being up, and the Dow was up. All the other indexes during the 5 trading days ended up being down. And this looks over exaggerated here because small caps were down, but it was a little over 1%. So, I mean, it looks like, well, they fell off a cliff. Nah, you kind of have to look at the context of the picture here. But year to date, all of the different indexes are still positive with the NASDAQ and S&P doing the best. Different sectors. Energy bouncing up. This is mainly geopolitical. It really bounced up over almost 7% here. The financial sector is holding together and utilities continue to be strong. Communication, that's a growth area. We like that. And staples going down. We like that too if we're positive on the market. Healthcare, another defensive area. We like that. Tech was up barely, but that's another growth area as well. Then on the next chart, I ranked them over on the side here according to their scooter score. The closer to 100, the better looking that sector. Utilities are still looking the best. And then in second place is communication in the 80s, industrials, and then discretionary. And the energy sector was doing really bad, but it had a really good week this past week. And then you get down into these other areas that are not performing as well. When I consider a sector to be doing well, it's when it's into the 90s. I may start to look at it if it gets up into the high 80s. So for the week, looking at the sectors, energy had a solid week. And again, that was mainly geopolitical, financials, utilities, communication were up, and industrials. The other sectors were down over the 5 trading days. And going back to the beginning of the year, utilities are still the strongest area, followed by communication. All of the other sectors, based on the way this is calculated, not taking the S&P into account, there are negative year to date. Then we look at the relative rotation graph here. And remember back to your geometry class, the upper right-hand corner, that's the X axis here. And this is real estate, which has really been coming on. But as rates have been going back up, we're seeing real estate start to trail off. Utilities have been strong as well. Now, usually utilities do well because the market's getting ready to go down and it's a defensive area. Well, because of all this green stuff, utilities may actually be turning into a growth area. How are they going to make electricity for all these cars and for AI and for the crypto mining, especially if you're going to try to do away with the other kinds of energy that we've already had? We still need electricity. And so maybe this is a growth area instead of just looking at this as a defensive area. And we're seeing a little bit of rolling over here, like with the staples and so forth. The area that's kind of weak right now is tech, but it is starting to turn up. However, it's red, as is energy. But we want to see tech doing better. We want communication to be doing better. That's XLC right here. Those are the real growth areas of the market. And we'll see if they can start to improve. But also beware, this chart goes back over the last year. It's not looking at the last week or the last month. It's going over the whole year in total. And then this looks at it more like in a spreadsheet format where real estate, utilities, and staples, these are defensive areas, and they've been doing the best over the last year. Financials are holding up. We're waiting to see, because financials were doing really good back in 2007, and then they fell apart into the great financial crisis in 2008. So, but they were doing good about this time then too. So we just want to keep an eye on this. Healthcare, which is more defensive. And then we have energy and then tech. We want tech to do better. We want communication to do better if we're positive on the market. Then here's another relative rotation graph, just looking at the different market indexes where the utilities are the strongest, but they've been really starting to come down. Small caps were showing an improvement, but now they're trailing off. The Dow Jones Composite Average also trailing off. The NASDAQ 100, this led the market higher. This was the darling index that everybody wanted, followed by the S&P 100, which is the OEX, and the S&P 500. They're looking okay, but not great. But we're seeing a little bit of a turn up here with the NASDAQ 100. We want, in a good, solid environment, we want the NASDAQ 100, the S&P, and the S&P 100 to be up here in the green area. We're seeing transports, which showed a little bit of promise, starting to turn down. Mid-caps, a little bit of promise, but starting to turn down as well. Here's what they look like in spreadsheet form with utilities, the Dow and small caps doing a little bit better these days. And then you have transportation and the mid caps. And then the weaker areas are the S&P 100, 500, and NASDAQ 100. Sentiment. We got the latest reading from the Investors Intelligence. They're pretty much neutral right now, coming in at 2.67. When they get above 3 or below 1, that's where we really take note of this. And then just to keep up with this, we're seeing it tighten up a little bit here with predictit.org. These are people that can actually bet on who they think is going to win the presidential election. There had been about a 10 or 12 point spread or cent spread here. Trump has been coming up as Harris has been going down over the last week or so. Looking at sentiment here, we are one tick away from getting a little concerned. When we get above 75, that means maybe the market's getting a little too happy right now. And to show you what I mean, here's a historical chart. And you can see, now we can stay up around the 75 area for a long time when the market's really steaming higher. But when we get up to this area, this is when we start to look at using this as a contrarian indicator. When we're really screaming to the downside and we drop below 25, that's when we look, okay, maybe a market bottom is in place here and we look to go up. Well, when we get up to a high reading like we're getting now, a little bit higher than this, now we're looking for some kind of a pullback or decline potentially. But we don't use this chart to make decisions. We use this in conjunction with the other charts that we follow. All right, the latest reading from the active asset managers, not getting extreme right now. This is that same chart coming in at 86.93. When they get over 90, and especially when they get over 100, because these are human beings that manage money for other people, they run by emotions too, and they have peer pressure, and they have their own ego that they have to try to feed here. And so sometimes they end up having to chase some of these things as well. They're not really extreme right now. Another sentiment indicator, still below this dashed line. So we're showing an improvement here, but this is not necessarily extreme. This is measured in a completely different way. That's why I like to show this chart. So we're not overextended with this chart right now. The VIX, which did go up over 20, but for the week, it's still below 20. When we get above 20, that's when we start to get concerned. It's still giving us a fairly high reading, but it's down from the readings that we were getting. This is still looking positive here. The black line is the tech sector outperforming cash. As long as this is going down, the tech sector is still holding up fairly well. And the Ridex bear bull ratio, when this goes up, people are bearish. When this goes down, people are bullish. And these folks tend to react to what's already happened, and they get whipsawed a lot. Since they see something happen, they react to that, and then the opposite ends up happening. And then they go back and switch back again, and it's really kind of interesting. Okay, now we're looking at the Ulcer Index, another fear gauge here. We're still below the moving average. We want to keep an eye on the spread between risky and not as risky bonds. This next chart somewhere, this chart actually gives us a little bit better indication. We're getting a high reading here, which means low fear, because I matched it up with the S&P and with the VIX here. So we're not concerned right now. We also got the latest reading from the American Association of Individual Investors. They dropped down a little bit, not as positive as they had been, but they're still okay. They're on the upper side of 0 right now and not extreme. We look at the VIX and then take a 3-month average of the VIX and do a ratio. It's starting to tick back up as we were under pressure a bit. It's actually more positive if this is going down. I'm going to look at a 253 period moving average because that's usually the number of trading days in a year, give or take. And when this is going down, that means the equity put call ratio is going down, which tends to be more positive for stocks. When it's really going up, like we were in 2022, see what the market was doing at that time. So this going down tends to be positive. Looking at the economy, we first look at the National Financial Conditions Index. As long as we're below the black line, we're okay. We get the latest reading of GDP now. We did get a recent reading on GDP. We're a little bit over 3%, according to this. But when you look at the top and bottom forecasts, it's about 2.5% to the upside and about 1.5% to the downside. This is another way to represent that. As I usually say with this chart, the takeaway is even looking forward, they're positive, because negative GDP for 2 quarters means we're in a recession. And we did get an update here. This actually fell down, which is just it's ruined the Perma Bears weekend, because we came in at 0.53. Then we went up to 0.57. Now we're back down to 0.50, which means we're okay now. But I don't follow the Perma Bears, but I get some of their emails, and they were using this as perfect indicator, never wrong, for 20 years, even though it was wrong before that. But this above the red line, we start to get concerned. Well, it was above the red line. Now it's starting to come back down. So I don't know what they're going to say about this. The Perma Bears, I mean. And if we do go and drop a little bit below the red line even more, that would be more positive for the economy. I have no trouble just decimating Perma Bears. I'm not a Perma Bear. I'm not a Perma Bull. I'm a Perma Realist. And that's what you need to be to have consistent success. We did get the latest reading from the smoothed U.S. recession probabilities. We're still under the red line. If we get above that, that's when we're concerned. Here's another reading, a little bit more blown up here. We're above the black line, but we're below the red line. So we're okay with that right now. We did get an update of the Brave Butters Kelly Leading Index. Unfortunately, this is a quarterly report. It is coming down a little bit after it had been starting to go up. And that's a good sign that this is coming down. And then we started a new quarter with the beginning of October. And this just looks at CPI, inflation, and core CPI, PCE, and core PCE. And not an awful lot of adjustments right now. We're going to get CPI in the upcoming week, and we're going to get PPI on Friday. Looking at the Fed, you can see a big change here. They think that as of the next meeting, which will be on November 7th, there's a 97.4% chance that rates are going to be cut 25 basis points. Folks were really rooting for that 50 basis point. Well, Jerome Powell came out and said, well, we may do a couple of 25, meaning 0.25% basis point cuts. And the market's kind of locked into that now. And that really got locked in. If you look at the next chart, a lot of this changed on Friday. The dark blue, that's Friday's session because of the strong employment report. Now, that employment report could have freaked out the market because it said people were working less and making more. That could be taken as inflationary. And the number of jobs that came out was way above what folks thought was going to come out in that report. And so we'll have to see if there's any more delayed reaction in the upcoming week to that strong employment report that we saw. Then looking out at the December 18th meeting, they're thinking that, okay, we're probably going to cut another 25 basis points after that meeting is finished. That's how things look right now, but it can always change. And you can see, that's why I show this chart. You can see how these really change over a period of time. All right, looking at the total assets, this is the Fed balance sheet here. And I always remark about this here. We're going down, you see, doesn't that look like it's going down? But see how the number's going up? Only a government chart can do that. And then we look at the year over year. Now this can be a little bit different here, where we're actually going down, but this chart is pretty much flat to slightly going up. Then we want to keep an eye on this. We saw a little bit of a spike up, and now it's coming back down. This is the overnight reverse repurchase agreements. We just want to see if anything weird is really happening in this chart, and not necessarily right now. Keeping an eye on breadth here. We're looking good when we look at the advanced decline line based on price and volume. And you notice we didn't break out to a new high based on price, but we did based on volume. That could be positive. When volume is leading price, not always, but a lot of times that can be a good sign for the market. We look at the new highs, new lows. Saw less new highs this past week, but we're still going up at the 4-week. We're going down with the 10-week moving average. This is a smart money indicator. Looking good. We're also looking good on the daily version of this chart. We're above an advancing moving average and not necessarily extreme as measured by this other indicator. This tries to measure the distance from the indicator to the moving average, and it's not an exact relationship between the two. So you kind of have to eyeball it as well. We are looking good with our advanced decline ratio. Both the blue line and the red line are above 0 and going up based on 19 weeks and 39 weeks. Our trend, this is when I say a weakening trend, and there's a whole spaghetti mess of lines here, but you can see the red moving average, we're below that. That means it's a weakening trend, but we're still above 20, which is a static number that we use that I settled on, because if you read books about the ADX, they say 25, 30. I've settled on 20 when it applies to the S&P 500. So if we drop below 20, that means we're not trending. And if we're below the moving average, that means it's a weakening trend. But which line is on top? The green line. Even though it's coming down and the red line's going back up, we still default to positive with this chart. So we're still on a positive trend, but it is weakening. We look at the Erin indicator, which tries to measure the distance between buyers and sellers, buyers in green, sellers in red. Still looking quite positive here. The oscillator down along the bottom measures the difference between the green and red line. Mass index, thought we might have been getting some kind of a signal here. We went above the red dash line, but we need to go up over the blue line for this to actually be legitimate, and it hasn't done that yet. So looking at a daily chart, we've just been really chopping around sideways. We had a good up day on Friday, but we just came into the higher end of the range that we've been in lately. The concern that I'm seeing is I have a moving average on here, and we've been below average with volume pretty much for the whole week. But when you look at the Keller market model, we're positive across all time frames with the S&P, mid caps, small caps, and the triple Qs, or the NASDAQ 100. We've switched to a short-term downtrend with bonds based on price. We've seen a pickup in commodities. A lot of this has to do with oil, and gold has been going up. So we're positive in the short and intermediate term, still negative in the long term. And the dollar had a good week, and I'll show you a chart of that later. It's now switched to a short-term uptrend, but it's still going down in the intermediate and long term. And actually extended this out a little bit. This is a trend channel going back to 2009, and we're still below this upper side of the trend channel. We're still well above the midpoint of the channel. This is a weekly chart too. The S&P 500, we are well above this R2 level, and that's positive. And I've been showing this chart in the daily videos. Then we look at the S&P and take a 50-week moving average. The red line is the 50-week moving average. That's going up and price is going up and above the red line. That's positive. Then we use a moving average crossover where I use a 13-week in blue and a 50-week in red. And all the lines are going up and price is above both of the lines. So that's positive. And we're actually going down a little bit here with the McClellan oscillator. We're also negative on the daily charts with the McClellan oscillator. That's a little bit of a concern. We would like to see this come back and cross back above zero, both on the daily charts and here on the weekly charts. So that's a bit of a warning sign. But when you look at the summation index, we're still getting a very high reading, even though it's coming down. We're not getting a high reading based on volume. It did decline, but both of these are still positive. And the bullish percent index giving us a very high reading. It started to come down and then it went back up a little bit on Friday. You can see other times, match it up with what happened here. We would hit a very high reading with this and then look at what the S&P would do after that. Not all the time. We had a very high reading here and then we just slowed down for a while and then shot higher. But sometimes this can mark a reversal. The Swenlin trading oscillator dropping below zero based on price. We're also negative based on price on the daily chart. We're declining, but still slightly positive, both here on the weekly chart and on the daily chart. Momentum, still having a really hard time, just chopping around with the PMO. We declined a little bit based on price, and we're actually up a little bit here based on volume. So the PMOs that are rising, coming down a bit, the buy signals coming down, and we're also getting the same reading on the daily chart with the PMOs that are above zero. That could be taken as positive. That's the percent of PMOs inside the S&P. So all the stocks that make up the S&P 500, we're still seeing a lot of them above zero, which means their PMOs are positive. Now, another thing that showed a lot of improvement on Friday was the daily chart of the chicken money flow, another smart money indicator. We're holding up okay here, but we're flattening out where we are seeing more positive action in the daily chart. And then the chicken oscillator starting to get back up to this extreme reading. That's a green line that I put on here. There's nothing magical about it. I just use it as a reference point, but this is still looking positive for the time being. And then we look at the momentum, the short term trying to turn back up, the TSI trying to turn up, the MACD. You can see we're still negative with the longer term oscillators, where the short and intermediate term oscillators are trying to turn back up. We're not extreme right now with the percent B. This measures when we're above or below the upper or lower Bollinger Band, and we're not there now. The positive takeaway from this chart is we're above the midpoint. Forest Index declined, but it's still positive. Above 50 and advancing with the money flow index. And we're right a little bit below 50 with the Stoke RSI. That's looking better. The RSI 14-week is still above 50 and going up. That's positive. And we're actually declining a little bit here with the ultimate oscillator, but we're still above 50. So it's declining, but we're positive. And we're looking extreme positive here with the Williams percent R. I showed a chart in one of the daily videos. See, I go back like a year on this chart. Well, this chart went back decades, and we can stay up in this area where we're extreme positive for a long time. That just shows that momentum is pretty solid here, but we're still overextended. So sometimes it means the party is over and we start to drop with this indicator, but we're not seeing that yet. The vortex, even though we declined a little bit, still has the green line above the red line. We showed a little bit of improvement on Friday on the daily chart, and it's still positive as well. We had a slight up week, so we're slightly above the midpoint with the rate of change going back 1 week. When we go back 50 weeks, we're kind of leaving this red line in the dust, which is what I was pointing out earlier, and we're getting some pretty high readings. Now, you could say on one hand, that's negative because maybe we're overextended to the upside. On the other hand, this going up can say, wow, look at that long-term momentum. That's positive. The weekly special K chart still cannot seem to get above that blasted moving average. And the copy curve trying to turn back positive. This is another momentum oscillator. We're turning positive on the daily charts. No, we're turning negative on the daily charts, where we're trying to turn a little bit more positive here on the weekly chart. And this is just different support levels, and we didn't even come close to any of them this past week. So we're looking good here with the trend. Looking at a Heiken Ashi chart here with the open candles. That's positive. We're still going up at the Renko chart, which is positive. The Kegi chart is positive. We're black and pointing up. And the three-line break, another way of measuring trend here. This has open candles also looking positive. We didn't get anything new with the point and figure chart, but we're still working off of a triple top breakout that was generated on September 16th, which I pointed out last time. We're getting a double top breakout, which was generated on the daily version of this chart. I guess they're both still good. You want a double double or a triple double when you go to In-N-Out Burger? Okay, so the 14-week ease of movement, we're slightly positive here. And we're looking at our long-term momentum, seeing a little bit of improvement in the long-term, intermediate term. We actually flattened out after declining in the short term. 50-day cycle. Don't put a lot of importance into this. Sometimes it means something, sometimes it doesn't. But we are looking positive with the Elder's Impulse system on the weekly chart of the S&P. We switched over to negative with the parabolic SAR chart on the daily version. We're still positive here on the weekly chart. And then looking at just the indexes themselves, we just came off of a recent all-time high with the S&P. Mid caps are still going sideways, small caps still going sideways. The Dow in a solid uptrend, setting an all-time closing high on Friday, not an intra-week high here, but it was a closing high that was set. The NASDAQ is still looking pretty strong here. The NASDAQ 100 also looking quite strong. Here's another chart of the NASDAQ 100 where we had an up week, not by very much, but it was an up week. The mid caps cannot seem to break out of these recent high prices that we've seen. Small caps also kind of fighting around here. They bounced up off of this blue 13-week moving average, but they can't seem to really break out. They like thrust up and then go back, thrust up and then go back. It's like, tease me some more here, small caps. We are setting all-time highs with the NYSE. The Wilshire is a daily chart. We didn't set an all-time high this week, but we did set an all-time high last week. And we really bet most of this gain that you see here was in Friday's session. 30 biggest software companies looking better and in an uptrend. All stocks, which looks at US stocks as well as international stocks, also looking quite positive. The FANG index not back to an all-time high, but still looking solid. ARC still in a downtrend, was actually down 2.78% on the week. And the banks, we want to keep an eye on this. Still looking solid on this weekly chart. Above 50 with the RSI. We've been going more or less sideways as far as the bar action here, and that's causing the momentum to just kind of jiggle all over the place, not really giving us any kind of conviction. We are seeing money going back into banks as far as deposits. I look at this as a confidence type of indicator. We're now into October, where we're done with September now, which ended up being positive, but usually it's negative, where October tends to perform a little bit better. Then looking at a weekly chart of Dow theory, coming off of setting an all-time high. Transport still going sideways. Utilities have just been on a tear lately, but not necessarily setting an all-time high, at least yet. Looking at the broad market, commodities, which were in a downtrend, and we're still in a downtrend, but we were up over 2% on the week with the commodities. Energy makes up a huge part of that, and unrest in the Middle East is a large part of that as well. Precious metals, well, 7%, but that's gold doing better. Oil, which had been below 70, is now getting into the mid-70s. We want to keep an eye on that one. Here's the dollar. We came right down to this 100 level and just bounced up off of that. That's a huge move in 1 week. Even though we're still in a downtrend here on the weekly chart, we're also in a downtrend on the daily chart. Copper, which is looking better, and this really went up, at least in Friday's session, even though we closed off of the high, because the economy is looking better. When this is going up, that means the economy is looking better into the future. When this is going down, that means there's concern about the economy going forward. Gold, just coming off of setting recent all-time highs and in a solid uptrend. We also see a little bit of a breakout here with silver. It was up on the week and also in an uptrend. Keeping an eye on the price of bonds. See how we really fell back with bonds based on price with the total bond ETF. And with bonds going down and stocks finishing slightly higher, we're turning back up, and we're starting a new month now that we're in October, because this is a monthly chart, showing how stocks are continuing to outperform bonds. And then we see this is a daily chart where the yields were just coming down like crazy and now starting to go back up. At some point, the stock market's going to look at that and it's going to matter, but it doesn't seem to matter at least through Friday's session. This is a weekly chart showing how we're going back up with US and UK rates. German rates went back up and even Japanese rates went up slightly. Then looking at some relative studies, this is going back to the beginning of the year and looking at intermarket analysis, where gold is still doing the best, followed by stocks. And then we have oil, which is going up again for geopolitical reasons. And then the dollar is in green, that's going up. And now bonds have switched to being negative year to date based on price. We look at a ratio between the NASDAQ 100 and the S&P. The NASDAQ 100 has been underperforming as the S&P has been actually doing a bit better lately. The S&P 100 compared to the S&P 500, it had been pulling back, showing a little bit of strength here in the latest reading. We want growth to outperform value, and it still is doing that. But after really falling back, now it's starting to show some improvement. Gold to S&P, this is what I'm talking about. We're not really seeing any breakout here. Now, this is just where I'm coming from here. If you got into gold at just the right time and you're sitting pretty, you're happy. Well, if you had been in the S&P, you'd be pretty happy right now too. Gold to the dollar, it came down a little bit as the dollar was going up, and we saw a little bit of a decline in gold on Friday. Bonds continue to underperform stocks with this ratio. Low volatility compared to the S&P 500 starting to come back down again here. Discretionary to staples. We are seeing a big improvement in discretionary, but it's still in a downtrend here on the weekly chart. Energy to tech. Energy's been bouncing back up. Tech's been under a little bit of pressure lately, but overall, energy is underperforming tech. We look at small caps to tech. Just jumbling around here. Just having a fit. You can't really decide what it wants to do. Long-term charts here, still looking positive with the NYSE breadth thrust. We're coming down a little bit, but after getting some really high readings with the ZWAG NYSE breadth thrust, these are the statistics. After we get a ZWAG NYSE breadth thrust, especially when you go out a year, you're up 100% of the time. Even 6 months later, you're up 100% of the time. And these are the returns. The question mark is we're still working off of one of those signals. This is a long-term trend of the S&P 500 going back to the 1987 crash. We're still well above that trend line. This is a blow up of that same chart showing that we're still well above this support level. This is the 50-period moving average of the new highs, new lows on the NYSE, still going up. That's broad market, and that is looking fairly positive. This is a 50-period moving average just for the S&P. It's actually starting to come down a little bit, but we're still well above zero. If we can keep going up, it would probably turn this back up as well. If the S&P keeps going up and this keeps going down, that would be a negative divergence that would concern us. We're still on this thing called the Zahorchak method. Doesn't generate very many signals, but this is a full-on buy signal for the time being. Looking at the NASDAQ 100 weekly chart, still above this long-term trend line going back to 2009. We're looking at the Qs, NASDAQ 100 to small caps, coming right back to this blue line here. So this is holding up quite well. We look at another ratio of the NASDAQ 100 to the Dow. Even though the Dow's setting an all-time high, we're still looking really solid with this ratio. This is something we are watching. Because see what happened back in 2007 into 2008 when the 3-month yield really started to go down? Well, we're coming down now, but we have to look at the context. This led to the great financial crisis. The financial sector is holding up for right now. So this coming down could be just a reaction to the Fed lowering interest rates. But we want to keep an eye on this anyway. When we look at the cumulative new highs, new lows for the NASDAQ, showing some improvement here. This is very long term. This is just a daily score, and we're above zero here with the NASDAQ. And the NASDAQ's been outperforming the NASDAQ 100, and that's more broad-based. Then we have this Hindenburg-Ullman. Here is the definition of that. We did get a confirmation. 1 spike is when the perma bears just start having a party. 2 spikes, they're ecstatic. And this is on the books now for a while. We haven't seen any other spikes, but it was confirmed once we got the second spike. Just to see that we need to pay respects to this, we saw a bunch of these spikes right before the COVID crash. And we also saw a number of spikes over a period of time right at the end of 2021 going into 2022. That's why we watch this chart. It could take some time for this to play out. Seasonality. September, actually, it should be October. I highlighted the wrong month here. Sorry about that. Wasn't September a good month? We're actually up in October 60% of the time with a return of 1%. But here's another seasonal chart but it hasn't seemed to matter to this point. We should already be going down due to seasonality on a historical basis, but we're not. But that could come into play at any time, but we're just not seeing it happen right now. Now we're finally out of September into October, which back to 1950 here tends to be not great, but positive. And then looking at October here on a world basis, also looking good after August and September are typically negative. And then we had those good summer months, bad September. During an election year, according to Carson, we tend to see negative returns from 1950 to 2023. This also shows some potential weakness in September and October. That's why I show a lot of different charts here, because I don't base everything around one. We just look for a consensus of what are these charts telling us on a seasonal basis, and then we follow the real charts of what's really happening, and that's where we make our decisions. We just use this as a form of gathering information. Now, I did switch this over. The first half of October is probably the third best performing time of the year. And then when we get into the second half of October, that does well, but not quite as good. Looking at September, October here. So we had a good August. September ended up being positive, where we still might have some weak seasonality according to this chart. And we also see some weak seasonality, especially with the NASDAQ here in October, both for the NASDAQ and S&P 500. But we could always buck the trend. We've been bucking it so far. This also shows the whole period from August to October, which that 3-month period of time tends to be negative overall. And then during an election year, that's when we tend to see October not doing as well. But we could always go against that. And then this was a newer chart this past week where for the fourth quarter, since that's what we're starting right now, this is when we tend to see the most positive time of the year. Then going back to 1950, we're up 9 out of 18 times, down 9 out of 18 times, 50% there with a return of minus 0.9%. Thank you. I really hope you have a great weekend, and I will talk to you in the next video.